Hello and welcome to Budget with Business Standard. I'm Nivedita Mukherjee. Today's show will attempt a deep dive into the privatization initiative of the government. We also have a hardcore numbers man who will tell us what the budget could do. Plus, there's much more. If last year's budget stood out for the centre's bold resolve to privatize public sector enterprises, this year the focus could be on execution. Privatization returned as a reform strategy in 2021, more than 2 decades after Vajpayee government's stake sale rush. But most of the privatization plans announced last year are yet to take off. How will the coming budget balance it out as the government plans a complete exit from some sectors? This report will explain.
With a clear public sector enterprises policy for Atmanirbhar Bharat, laying out the government's intention of limiting its presence in strategic sectors and privatizing or closing PSUs in non-strategic sectors, there could be an increased push to privatize non-strategic PSUs next financial year. In the present year, the government's focus has been on completing pending privatization transactions, but the COVID-19 pandemic and the restrictions therefore have made the task difficult. Although the centre found a buyer for Air India, some big ticket divestments like Bharat Petroleum Corporation Limited have been reportedly delayed as bidders are struggling to find partners. Even as the government would continue with such sales, it will also initiate the process for non-strategic sectors which are expected to interest private participants more. In all, there have been about 50 public sector enterprises that have been identified in both strategic and non-strategic sectors by the Niti Aayog for privatization. In its effort to push privatization of PSUs in non-strategic sectors, the centre has tweaked the process. Earlier this month, the government empowered the Department of Public Enterprises, which has been brought under the Ministry of Finance, to identify PSUs in non-strategic sectors for privatization. This is a change from privatization in strategic sectors, where the Niti Aayog identifies candidates and DIPAM takes approval of a panel headed by the Cabinet Secretary before finally taking the proposal to the Cabinet. The change in the privatization process has been done to fast-track approvals, as the divestment process is time-consuming and market-driven. The government has also announced that its focus now would be privatization, and minority stake sales will take a backseat.
The government has to basically first finish up the pipeline. Right now, if you see the kind of assets which are up for sale in terms of monetization and divestment, you have the names of the big bigs like BPCL, Concor, BEML. So all these are big names, including SCL for that matter. So what the thing is that because of, these assets which are considered to be the best for sale are first to be monetized, and they have been derailed because of the long drawn process which the government actually has because of their own standard protocols. So though there is a target of 1.75 lakh crores, to be taken from the divestment, but fact of the matter is only about 43,000 crores have been realized. So these have to be streamlined and act upon in a faster way so that all these targets which have been set by the government could be met within time. Other thing which the government has to do is that basically it could bucketize certain assets into 3 categories. These categories would be such that, for instance, assets such as BPCL, SCIL of the world, which are actually bankable and marketable, they should be given a category A. Then there should be certain assets which should be revived, but they are not doing very well. They should be brought to category B. And thirdly, there should be certain category of assets which are actually dead assets. And those PSUs, the state-run PSUs, are all shut. Then basically the government should identify what kind of assets can be stripped out of it and how to gain maximum from these kind of things. So rather than just saying that, strategic and non-strategic, I would say identify assets into certain buckets and then basically create a pipeline for monetization of these assets. So before getting into this kind of asset monetization, which is actually a very grand plan, the government actually should appoint right kind of agencies to do a precursor to these particular companies, and see that, what kind of companies should come. And thereafter, once this study is done, then you will know that what are the real bottlenecks. For instance, when we talk about LIC is not only regulated by IRDA. LIC has to be basically also brought to the fore in terms of SEBI. LIC also has to be seen from the light of FEMA. Once these bottlenecks are already identified, then the government actually can give a very good remission, or I would say concession, on plate, to the investors, because these issues are already identified and can be deliberated in a better way. I would say that instead of saying a blanket SOPs in terms of tax exemption or anything, rather a precursor study should be done.
Another area that would see a renewed push would be privatization of two public sector banks. Recurrent disruptions in parliament by the opposition has deferred legislation to enable the privatization of PSBs as announced in Budget 2021. These legislation are now expected to be introduced in parliament during the budget session. Even as the government is looking to privatize two PSBs, it is looking to hold at least 26% in these lenders, according to the proposal moved by the Department of Financial Services. News reports suggest that the Niti Aayog has identified Central Bank of India and Indian Overseas Bank for privatization. The government will likely complete the process to privatize one public sector insurance company next year. The Niti Aayog had suggested privatizing United India Insurance Company. Besides privatization, the government is also expected to push its 6 trillion national monetization pipeline and bring states on board to share their plans to monetize assets. It is expected that the finance minister will provide some incentives to private sector to make participation in the monetization process attractive.
What is needed from the private sector is a time-bound rollout of the program, and that's very important and critical. The other aspects in terms of fiscal parts of it will be very limited, but in terms of ease of doing this is important. What I mean by that is from ease of exit for a successful bidder, assets to be given with as little of baggage, either in financial or in operating terms. The third important one is some level of standardization of process, also delegation of power to the concerned authority, and guarantees if the user fee has a component which can get impacted by government policies. Last but not the least is comfort and continuity of the terms of the contract. I think these are the 4 critical things that the private sector will be looking at in terms of the asset monetization. A like-to-like kind of a contribution could be one part. The second could be, if in terms of financial aspects, I meant towards the debt part of it. If there's a significant debt overhang on a particular asset for any reason, then remove those away from the project and give it as clean as possible. So that is what will be more important. So the fiscal incentives can come in that particular nature to a particular project, because at the end of the day, it's an asset that we are talking about. So it's very difficult to have any kind of a tax aspect linked to a particular asset. But those debts, which is specifically to the SPVs, those can be taken away.
Pronab Sen, noted economist and former chief statistician of India, had argued against the timing of the privatization announcement. According to him, privatization is best done when the economy is booming, and that it's a terrible move in a slump. Dr. Sen is here on the show to talk on a wide range of economic issues. Listen in to his conversation with Asith Ranjan Mishra.
Hello, Dr. Sen. Welcome to the show.
Good morning.
What are your initial thoughts? The fast advance estimate of GDP has been released. So what do you think about it?
In a sense, I think it confirms a lot of our worst fears, which is that consumption is not doing anything at all. And what it is essentially pointing to is, despite the fact that the GDP is above, slightly marginally though, above what it was in 1920, consumption is seriously below that level, which means that there is something that is happening in the system which we need to take account of. There have been such significant income distribution effects that the lower tiers, who are the high consumers, they have lost in favor of higher income people who are high savers. And that's something that we need to worry about a little bit. We know that capital formation in the government and in the corporate sector was fairly strong. We know what has been happening in the capital markets. But given the kind of weak numbers that the banks have been putting out, right? The gross capital, fixed capital formation number came as a surprise. And really the question then is, where are these numbers coming from? Because the banks are still not lending very much. They've just stated their intent to lend in the current month.
Do you think then the fast advance estimates are actually overestimating the GDP growth?
I suspect it is. In any case, I think it is that it doesn't factor in the third wave at all. Okay, with the third wave, we don't even, at this moment, we don't know how the third wave is going to play out. But what we do know, and this is the important thing, is it doesn't depend so much upon the spread of the disease. What it depends is upon the kind of restrictions that various governments at the state level and at the local body level, they put in place. That's what has the large economic impact. If they do what they did during the second wave, I think we can confidently expect the economic effect to be similar to what happened during the second wave, which was about a 7.5 percentage point decline in GDP.
So do you mean to say we can even see a contraction in the fourth quarter? That's what you are
It is possible, if lockdowns happen, right? But if states start doing what they did last time around, which is put 2-3 week lockdowns at a stretch where no economic activity is permitted, yes, we could see a negative growth. But as I said, this is entirely dependent upon the kind of policy reactions that the state and local body governments have to the spread of disease.
So the Finance Minister, Nirmala Sitharaman, will be presenting her fourth budget in a few days from now. What do you think are the major challenges before her?
Well, you see, the big challenge, I think, is inflation. The CPI may be muted, but the WPI is high, which means that sooner or later, there is going to be a pass on. We don't know when it will happen. It depends upon the extent to which the consumption side starts responding, but there will be a pass on sooner or later. So inflation is a challenge. But what the finance minister can do in the budget is to take the responsibility for growth away from the monetary policy and bring it squarely into fiscal policy and instruct RBI to look after the inflation problem.
And so what can the finance minister do when it comes to fiscal expansion in the budget? Which are the sectors?
Well, that is the big question, right? So far, tax collections have been very good, and we have no reason to believe that they will not continue to be good next year. They are well above what the government had expected. Non-tax collection, in any case, when the last budget was presented, I think we all collectively had serious doubts about those numbers, particularly the disinvestment numbers. That problem continues to persist. But the tax collection numbers does give the finance minister a fair amount of headroom to do an expansionary fiscal policy. She should actually take advantage of that headroom and have a fiscal expansion and tell RBI to focus on moderating inflation.
Thank you, Dr. Sen, for joining for the show.
No, it was a pleasure, Arshit, and all the best.
Pronab Sen's warning is clear. Inflation could be a big worry in the coming days, from inflation to taxes. Unlike the shortfall in disinvestment target, direct tax collections are set to overshoot the budget target. This buffer will be a timely help for the government. Here's a ready reckoner on direct taxes.
Direct taxes already constituted 63% of the budget estimates in the first 8 months of the current financial year. Even on a pro rata basis, these would almost meet the budget estimates by close of the year. However, much of the collections for both personal income tax and corporation tax come in the month of March. For instance, in both 2019-20 and 2020-21, as much as 22% of the total direct taxes were collected in March. This indicates that the revised estimates in the budget would show higher tax revenues than pegged in the budget estimates. Direct taxes had touched almost 32% by November of the previous financial year and 42% in the corresponding pre-COVID period of 2019-20. Not surprisingly, the actual collections fell short of budget estimates by around 30% in 2020-21 and about 21% in 2019-20. Corporation tax was contributing more than personal income tax to the direct tax kitty till 2019-20. But then the government decided to overhaul the corporation tax structure to incentivize industries to set up manufacturing units in the country. For those coming out with fresh units, the rate was reduced to 15% from 25%, exclusive of surcharge and cess. In general too, the corporation tax rate was reduced to 22%. Due to the effect of COVID-induced lockdowns on companies, personal income tax contributed more to the exchequer than corporation tax in 2020-21, albeit by a small margin of 12,000 crore rupees. The government pegged collections from personal income tax higher than corporation tax by 14,000 crore rupees for the current financial year. Both corporation tax yielded 7,000 crore rupees more than personal income tax till November. In the corresponding period of the previous financial year, it was personal income tax which had fetched 49,000 crore rupees more than corporation tax.
Now to something that has universal appeal, common man's budget. What good is a budget if it does not give a list of what's up and what's down in terms of prices, some may argue. But here's another point of view explaining why the union budget continues to be relevant for the common man. So don't go away.
Since 2017, most types of indirect tax, such as the excise duty and service tax, have been subsumed in GST. These do not see any tinkering in the union budget. Any changes to GST rates are approved by a federal body consisting of union and state finance ministers. However, many indirect levies like cesses, mostly on petrol and diesel, and customs duty on imported items are still tinkered in the budget. Most importantly, the budget is keenly watched for any changes to income tax rates. At present, annual income of up to 2.5 lakh rupees is exempt from tax. Any income over 2.5 lakh and up to 5 lakh rupees attracts 5% income tax. 5 lakh to 10 lakh rupees attracts 20% and a 30% tax is imposed on income above 10 lakh rupees. From April 2020, an alternative tax regime was introduced by the government which disallowed some exemptions. The new regime attracts 5% tax on income between 2.5 and 5 lakh rupees, 10% on income between 5 lakh and 7.5 lakh rupees, 15% on 7.5 to 10 lakh rupees, 20% on 10 lakh to 12.5 lakh rupees, 25% on 12.5 lakh to 15 lakh rupees, and 30% on income beyond 15 lakh rupees. However, the new regime found few takers. In FY21, personal income tax of 5.75 trillion rupees was collected by government compared to 5.55 trillion in FY20. Another thing for which the common man will watch the upcoming budget on February 1st will be a scheme like the Mahatma Gandhi National Employment Guarantee Scheme for the urban poor amid rising job losses due to the COVID-19 pandemic.
As we just saw, there's a still lot left for the common man in the budget despite GST taking the thunder away. That's all we have for you today See you on Tuesday with plenty of new talking points.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.